If you're a Pfizer colleague that's planning your retirement, or if you've heard rumors that your position might be eliminated, there's really 5 key areas that you need to understand before making any major financial decisions. And I'm not going to spend a lot of time talking about retirement planning, but more around the Pfizer-specific nuances. Things like the PRAP, the PSP, the PSSP, your LTIs, as well as the RMS. I'm Brennan Decima, owner of Decima Wealth Consulting and certified financial planner, and I've helped hundreds of Pfizer colleagues transition into the next chapter. I know your benefits inside and out because I've worked with Pfizer colleagues for years as they go through this major milestone. All right, the first decision that we're going to review is the PRAP and what to do with it. And if you've started with Pfizer before 2017, you may be eligible for the Pfizer Retiree Annuity Plan. And deciding on what to do with that, in my opinion, is one of the most consequential decisions you're going to be faced with as you transition from Pfizer. So let's understand why that is. If you decide to take the annuity, Pfizer is going to send you a monthly payment for the rest of your life. And for a lot of colleagues, that predictable income gives them a ton of peace of mind in retirement. It gives them the confidence to spend. That's pretty powerful. However, if something happens to you and you've taken the payments, there is no pot of money left over for the heirs or your loved ones when you pass. Now, the other option is to take the lump sum, and you can roll that over to an IRA so you're not paying taxes on the lump sum, and you can invest it in how you see fit. Now, for some people, they believe that they can get an investment return that's better than the rate of return they would have received on the payments. Now, for some people, that means exposing themselves to volatility. And some people are comfortable with that, others aren't. The onus is on you, or if you hire someone, to manage that pot of money. And for some people, that's stressful. For others, it isn't. Now, some Pfizer colleagues take the lump sum, but they still want the predictability and stability of payments. So they go out and they look at private pensions, guaranteed income annuities. Now, the benefit of that is you can still get the payments and get peace of mind, but you can add a beneficiary, whereas if something happens to you, Pfizer doesn't keep the rest of the lump sum, but your family keeps the rest of the lump sum. And that's pretty powerful for a lot of people as well. So let's talk about how it is calculated. The PRAP is maxed out at age 65. So once you hit 65, your PRAP benefit cannot get any bigger. So you can keep working and you can keep getting paid and getting bonuses and getting LTIs past age 65, but the PRAP is no longer growing. So I want to be really clear on that. Now, if you're not retirement eligible, the PRAP is reduced by 6% for each year you take it prior to age 65. That's if you're not retirement eligible. 2 ways to be retirement eligible. You can either be age 55 with at least 10 years of service, or age 62 with at least 5 years of service. So what happens when you're retirement eligible? If you're retirement eligible, the pension benefit is reduced by 4% for each year you decide to take it prior to turning age 65. Now, there is an exception to this. For some, they have hit the magical rule of 90. Now, rule of 90 is your age plus years of service have reached a total of 90 or more. When that happens, even if you are not 65, you receive the full Pfizer PRAP benefit. You've maxed it out. So let's say you've hit rule of 90 and you're only 61, you're not getting that 4% reduction for each of those 4 years. It's not 16% less. You're walking away with 100% of your benefit. So rule of 90 is pretty powerful. Now, the other thing is, how is the lump sum calculated? So the payments are based off the formula years and age and years of service, right? But the lump sum, and this is what a lot of people don't know, also depends on interest rates and the interest rate environment at the time you take it. So you may have seen a few years back when interest rates really spiked, your lump sum balance, the payments didn't change, but the lump sum projection dropped substantially. On the other hand, if we see rates drop, all of a sudden you're going to see your lump sum balance go up. So this is something to be really sensitive to. If you think that rates are going to go up, there's a chance that if you want the lump sum, your total available to you will be lower. On the other hand, if you think rates are going to drop when you're leaving Pfizer, you may see that your lump sum option grows. So that's something to be sensitive to before electing your pension as well. Now, if you leave Pfizer before age 65 and you hold off taking the pension, you have to make that election by turning age 65. So something to think about in advance. So hopefully this is helpful as we move on to the next topic. Okay, the second thing that I'm going to cover is the Pfizer Retiree Medical. Now, the Pfizer Retiree Medical allows you to continue your Pfizer health insurance on your own dime if you are retirement eligible. So as a reminder, retirement eligible, age 55 and at least 10 years of service, or age 62 with at least 5 years of service. So once you leave, you still have access to that insurance, but you're paying out of pocket. Now, Pfizer also offers something called the Retiree Medical Subsidy, the RMS. Now, the RMS is a notional account, but what that does is it pays Pfizer's portion of that health insurance until the RMS runs out. Now, the RMS is a notional account. So that bucket of money you see in the RMS, it only goes towards Pfizer's cost of the health insurance. It cannot be used for other health-related needs. It can't be used to pay for surgeries or doctor's appointments or medical bills. It's just going towards Pfizer's cost of coverage. Now, a point to be aware of here, 2 points to be aware of here, actually. Point number one, you need to be at least age 40 with 15 years of service to be eligible for the RMS. And the RMS maxes out at 25 years of service. So if you're 40 and you've worked at least 25 years, the RMS balance will be maxed out. It cannot get any bigger than 25 years. Now, the second point to be aware of is once you enroll in the Pfizer Retiree Medical, you cannot opt out and then choose to opt back in. Now, why is this important? Why does this matter? Well, a lot of people I know, when they leave Pfizer, they may take a break and then all of a sudden find a new opportunity, and they have new health insurance coverage from that new employer, that new opportunity. And they decide, hey, it's more cost efficient to switch to that new plan. Well, that's great. However, if you've enrolled in the Pfizer Retiree Medical and you switch to another plan, you cannot come back in and re-enroll in the Pfizer Retiree Medical. So it's really, really important to think about before opting into Pfizer Retiree Medical, are you strongly considering, or is it highly likely that you may have another health insurance option first? So many colleagues that I work with, this is where they capitalize on COBRA. COBRA allows you to continue coverage for 18 months before making the decision to opt into Pfizer Retiree Medical, just to give them a little bridge and buffer to determine, is this leave from Pfizer really, the last job I'm working, or am I thinking about going to another employer? Now, the last thing that I want to touch on is Medicare and Medicare eligible colleagues. So this is something where I really want to make sure, even if you're on that continuation of coverage, even if you're using the RMS, if you're Medicare age, you still need to enroll in Part A and Part B. And if you don't, there's some potential impact and cost involved in that. So it's really, really important to make sure we don't miss that enrollment window once you turn 65. The third thing that I'm going to touch on is the PSP, the Pfizer Savings Plan, the 401k. Now, when you leave Pfizer, you have options on what to do with the PSP. You can leave it in the plan, keep doing what you're doing. You can move it to a new employer. You can cash it out and pay a horde of taxes on it all at once, or you can roll it to an IRA. Now, a lot of people roll it to the IRA because it gives them more flexibility. It gives them more investment options. But before you do that, this is a common mistake that I see that really frustrates people. Most people are unaware of how the early distribution penalty works. So when you withdraw from a 401k or an IRA, the money you withdraw is added to your ordinary income for the year. Now, the IRA, if you withdraw before 59.5, not only is it added to your ordinary income, but it is also charged a 10% early distribution penalty. Now, there's an exception to that. If you leave Pfizer after turning age 55, but before reaching 59.5, you can withdraw from the 401k without paying that penalty. It's called the rule of 55. However, if you move it to an IRA, you lose the ability for those penalty-free withdrawals until you're 59.5. So I commonly see well-meaning advisors say, move it to an IRA. You have more investment options, you have more flexibility, you have more control. And that's great, but you also have a penalty if you need that money. So before deciding, if you're over 55, before deciding to roll it to an IRA, you may want to think about, what is my potential cash flow need between 55 and 59.5, and consider leaving that balance in the PSP to give yourself options, to give yourself flexibility, just in case you need money before turning 59.5. And that way, you get the best of both worlds. Okay, the fourth thing that I want to cover is for high earners at Pfizer. And if you are over a certain salary and GPP threshold, you may be eligible to contribute to the supplemental savings plan, the PSSP, or the Pfizer deferred comp plan. Now, there's a few key things to be aware of, and I'm just going to touch on the PSSP quickly. But the first thing to be aware of is, with these deferred compensation and supplemental savings plan, when you leave Pfizer, the balance is going to pay out on the distribution schedule that you have on file. You cannot roll that money into an IRA. You can't leave it in there for a time period longer than the distribution schedule on file. So what do you need to be aware of, and what matters as you're planning your departure? Number one, make sure the distribution is still in line with your cash flow needs. Now, what do I mean by that? The default election option for the PSSP is to pay out as a lump sum the January after you leave Pfizer. Now, if you have a small amount in the PSSP, maybe that's not a big deal. But if you're someone that's contributed to the PSSP year in and year out, and you've accumulated a hefty balance in there, well, now all of a sudden, you're looking at a major taxable event the year after you leave. And in some cases, you may end up significantly more, you may owe significantly more in taxes on that distribution than the taxes that you saved on the contribution. So critical to look at the distributions. Now, good news, you do have the ability to change the distribution schedule, but the IRS requires that that change happens at least 12 months before your final day. So if you think you may get wrapped up in that SSP, that special separation program, even if you change it, it may not actually go into effect. So the sooner you look at your distributions and how they're set up, make sure that they continue to align with your future cash flow needs and your potential tax consequences. Now, the other thing to be aware of with the PSSP is, because it's going to pay out, if you're planning on leaving Pfizer in the near term, you also want to make sure that your investment strategy is aligned with your time frame. So for many Pfizer colleagues that I work with, their PSSP is either in the S&P or in a target date fund. You may want to go even more conservative if you know in the next 3 months or 6 months, that thing's paying out, right? So get it into more of a short-term goal if that lump sum is going to occur in the short term. Let's talk about the treatment of long-term incentives when you leave Pfizer. So there's a number of different LTIs that Pfizer colleagues are potentially receiving. So we've got performance awards, TSRUs, RSUs. There's a new special RSU that was issued. For performance awards, regular RSUs and TSRUs, if you're retirement eligible, any grant that you have held at least 12 months is going to stay with you when you leave Pfizer. Any grant that you've held less than 12 months is going to stay with Pfizer. It does not come with you. Now, if you're not retirement eligible, anything that is vested comes with you. Anything that is not vested stays with Pfizer. When do they pay out? They all pay out on the normal vesting date. So those will continue to vest as they normally would. But if you've held it more than 12 months, it stays with you if you're retirement eligible. If it's less than 12 months, it stays. Now, this is where I typically see just people not being aware of it and leaving money on the table. Let's say you're planning to retire and you say, hey, a good time to retire is year end. I'm going to retire December 31st, 2027. Well, the grants that you received in February 2027, those are going to stay with Pfizer. Whereas if you leave in March of 2028, those grants from 2027 come with you. So that difference in 2 to 3 months can be a pretty meaningful difference in what you walk with. So if you're close to that 12 months, just be aware that hanging on a little bit longer can mean the difference of how much of your LTIs you end up taking with you. The final piece to all of this as you're considering your departure from Pfizer is how all of these puzzle pieces connect. And all of them can have a massive impact on what you take home and the tax consequences. So if you're getting the special separation program and receiving severance, that's going to impact whether or not you should take the Pfizer payments, whether or not the PSSP should all pay out as a lump sum, whether or not you're going to have vesting that dramatically changes your tax bracket. So most Pfizer colleagues, they really start to model out their first 5 years of cash flow 3 to 5 years before leaving Pfizer, because there's more levers at your fingertips while you're an active employee. But once you leave, a lot of those things are set in stone and we have much less wiggle room to play with. I'm Brennan Decima, owner of Decima Wealth Consulting. And if you found this helpful, please consider subscribing. I've helped hundreds of Pfizer colleagues navigate this transition, and I'd be honored to hear from you. That's what we do here. We're looking forward to hearing from you. Hope to catch you in the next video.